All right, stop scrolling. Seriously, hit pause on whatever you're doing right now. Because if you're thinking about buying a home in Nashville, you need to hear this. I'm about to pull back the curtain on the 5 hyper-local traps that are wiping out more bank accounts than our Broadway bachelorette party. And trust me, mistake number 4 just tripped up a surgeon last week. You don't want to be the next. Hey everyone, I'm Jameson, and each week I've had the privilege of guiding families through the exciting, sometimes chaotic world of Music City closings. And in all that time, I keep seeing the same 5 incredibly expensive errors pop up again and again. It's like a broken record, but with far higher stakes. So today, I'm not just pointing out the problems, I'm handing you the cheat codes, the insider knowledge, so you don't end up as the next cautionary tale being whispered about at the East Nashville coffee shops. This isn't just about avoiding financial pitfalls, it's about making the smart, informed decisions that set you up for success in one of America's most dynamic real estate markets. Let's dive in. Okay, this is a big one. Most buyers, bless their hearts, just plug Nashville into Zillow or whatever their favorite real estate app is and assume the whole city moves in lockstep. They think a market trend in one neighborhood applies equally to another, and that couldn't be farther from the truth. The reality is Nashville is a patchwork quilt of micro markets, each with its own rhythm, its own demand, and its own unique set of circumstances. Let me give you a concrete example. Back in May 2025, homes priced between $500,000 and $600,000 in a desirable area like Creve Hall were flying off the shelves, selling in a median of just 34 days. That's pretty fast. Now, take that exact same price range, those identical price tags, and move it just a few miles north to Germantown. Properties there, even at the same price point, were sitting on the market for 71 days before sellers even considered price cuts. That's a massive difference, more than double the time on market. And we're talking about areas within the same county. This isn't an anomaly, it's the norm here. Zip code level absorption rates can swing by as much as 22% inside the same county. What does that mean for you? If you're not digging deep, if you're not underwriting neighborhood-specific days on market and list-to-sell ratios, you're essentially flying blind. You'll either overbid in a soft micro pocket where you had all the leverage in the world, or you'll underoffer in a pocket that's still seeing multiple contracts and end up missing out on your dream home. This isn't about general market trends, it's about hyper-local intelligence. Nashville's real estate market, while cooling from its peak, it's still incredibly nuanced. We've moved from a frantic seller's market to what some may call a Goldilocks market. Not too hot, not too cold, but just right for savvy buyers. But savvy means understanding the intricate details. You can't just rely on citywide averages. They're often misleading. The fix? It's simpler than you think, but it requires diligence. First, demand your agent pull the last 90 days of data from the exact MLS areas you're interested in, not just a sprawling citywide average. That specific data tells the real story of buyer demand and seller expectations in that precise location. Second, have them run a price per square foot bandwidth of a half-mile radius of the properties you're considering. This gives you a tight, accurate valuation range. This 15-minute homework session, this small investment of time, can literally save you $15,000 or more. It's the difference between guessing and knowing. And in this market, knowledge is absolutely power. Don't leave money on the table by painting Nashville with a broad brush. Let's talk about one of Nashville's most beautiful features that can also be its most expensive trap: our creeks and rivers. A lot of buyers, especially those from out of state, fall in love with a home that has a serene wooded backyard with a gentle creek running through it. It seems ideal, but that beauty can hide a massive budget-breaking secret. It's in a high-risk flood zone. I worked with a family last fall moving here from Arizona who found this gorgeous updated ranch in Bellevue, backing right up to what looked like a peaceful little creek. They were ready to go all in. During our preliminary research period, we discovered that the back of our property, including a portion of the home's foundation, was in a flood hazard area. Your standard homeowner's insurance doesn't cover flooding. The mandatory separate flood insurance quote came back at $4,800 a year. That's an extra $400 tacked on to their monthly payment that they had never budgeted for. Their dream home instantly became a financial liability. This isn't a theoretical risk here. Anyone who was in Nashville for the 2010 flood knows how devastating this can be. Because of that history, lenders will not close your loan without proof of flood insurance, even if a sliver of the structure is in a designated zone. Finding this out a week before closing can kill your deal and cost you your inspection and appraisal money, and potentially your earnest money as well. The fix? It's all about proactive investigation. First, before you even schedule a showing, pull the property's address up on the FEMA Flood Map Service Center and Nashville's own Metro Water Services Flood Map portal. These are public, free, and they only take about 2 minutes. Second, if the property is anywhere close to a marked floodplain, you must write a contingency into your offer to investigate flood insurance costs. And during your inspection period, get quotes immediately. Don't wait for your lender to flag it. And even for a few $100s, you can also get an elevation certificate, which can sometimes prove the home itself sits above the flood level, potentially lowering or even eliminating the insurance requirement. This simple due diligence step can save you from a 5-figure annual surprise and a whole lot of headache. All right, let's talk about something everyone loves: free money, or at least money that feels pretty close to free. This mistake is all about overlooking incredible assistance programs designed to help you get into a home. And Nashville has some fantastic options. The Tennessee Housing Development Agency's, or THDA, Great Choice Program is a shining example. As of June 2025, it still offers up to $6,000 in forgivable down payment help. Yes, you heard that right. Forgivable. Plus, it comes with a sub-market 5.75% interest rate, which in today's climate is an absolute steal. But here's the catch and where many buyers miss out. These programs often have specific eligibility requirements and, critically, purchase price ceilings. For Davidson County, the purchase price ceiling for existing homes under the THDA Great Choice Program is $420,100. And I see so many buyers full of excitement blow straight past the limit, sometimes by just a few $1,000s, and lose out on that $6,000 grant forever. It's heartbreaking to watch because it's such an avoidable mistake. That $6,000 could be the difference between getting into a home or not, or it could free up some crucial savings for you. Now, why do these programs matter so much? Because every dollar you save on your down payment or closing costs is a dollar that stays in your bank account, ready for life's inevitable surprises. In an older city like Nashville with many charming 1950s homes, those savings could be earmarked for something like HVAC or roof, plumbing, electrical, you name it. So trust me, you'll thank yourself later for having that buffer. The fix? Don't just casually ask your lender about programs. Get pre-underwritten through THDA's portal before you even start seriously shopping. This gives you a clear picture of your eligibility and what price points you need to stick to. Then specifically ask your loan officer to layer Metro's grant on top if you qualify. That powerful combo can realistically drop your cash to close to around $2,500. Think about that. Getting into a home in Nashville for less than the cost of a used car down payment. It's absolutely possible, but you have to know about these programs and actively pursue them. Don't leave free money on the table. It's there for a reason, and it's there for you. Okay, prepare for a shocker because this mistake is costing people a lot of money and a lot of headaches right now. Nashville's phase out of non-owner occupied short-term rentals, STRs, inside residential zone areas became an absolute on April 1st, 2025. This wasn't a sudden decision. It's been a long, drawn-out process, but the final hammer dropped. So what does that mean? If you don't live in the property, you generally can't rent it out short-term. So think Airbnb, VRBO in most residential zones. Now, this isn't about being anti-STR. It's about understanding the specific legally binding regulations in this city. Nashville has grappled with STRs for years, and the city council made a definitive stand to protect the character of residential neighborhoods. Ignoring this isn't just risky, it's financially devastating. The fix? Before even thinking about making an offer, especially if cash flow from short-term rentals is part of your math, you need to do your due diligence. First, search the parcel on Metro's Maps portal. It's publicly accessible and will clearly show the zoning. Once you confirm the zoning, then you need to read BL 2022-135 line by line. This is the specific ordinance that governs STRs in Nashville. It's not light reading, but it's essential. If cash flow is critical to your purchase, then you need to adjust your search. Look for properties in commercial or mixed use overlays, which often permit STRs, or ideally find a property with a legal grandfathered permit that explicitly transfers with ownership. These are rare, but they do exist. Otherwise, plan on long-term lease income only. Don't assume you can skirt the rules, and do not rely solely on a listing agent's word. Verify, verify, verify. This one mistake could turn your investment dream into a financial nightmare. All right, let's talk about new construction, because this is another area where buyers are consistently getting tripped up. Inventory is definitely up, which is great news for buyers. We're seeing a 29% increase year over year. But new construction incentives? They're sneakier than a steel guitar slide. Builders are masters of marketing, and they know how to make a list price look incredibly attractive, only to nickel and dime you to death with hidden cost. You'll see a beautiful new home advertised at $459,000. Sounds good, right? But that base number often omits a whole host of extras that are presented as essential or non-negotiable. For example, that $459,000 often doesn't include an $18,000 lot premium, because let's be real, you do need a lot to put the house on, right? Then there's the $12,000 appliance package, because who wants an empty kitchen? A $9,000 HOA initiation fee, which somehow wasn't mentioned up front. And then the kicker, $7,500 in closing costs they'll graciously roll in if you use their captive lender, often at a half point higher interest rate than you could be getting independently. By the time you're done, that seemingly affordable $459,000 home is ballooned by tens of thousands of dollars, and your monthly payment has jumped by $312. That's a significant hit to your budget, and it's all because you trusted the initial list price without digging into details. Builders are in the business of maximizing profit, and they've perfected the art of the upsell. In a market where inventory is rising, you have more leverage than you think. Don't let them dictate the terms. The fix? You need to approach new construction like a seasoned negotiator. First, demand an a la carte sheet. You want to see every single line item, every upgrade, every fee broken down individually. This forces transparency. Second, and this is crucial, negotiate the lot premium down to zero. Yes, I said zero. In certain submarkets, especially in areas like Antioch and Hermitage, builders are desperate to move inventory. Third, always bring your own lender to the table for a comparison. If the rate spread between the builder's captive lender and your independent lender is more than 0.125, 1/8 of a point, then you need to seriously consider walking away from their financing. That seemingly small rate difference can add up to thousands over the life of the loan. In this current market, builders are holding around 6.2 months of spec inventory. And that's a lot of unsold homes sitting there. They want to sell, and you, the buyer, have the power. Wield it wisely. Don't just accept their first offer, negotiate every single detail. All right, we've covered a lot of ground, and I know this is a ton of information to digest. So if you're feeling a little overwhelmed, or if you want me to walk you through any of these specific traps, step by step on a live call, I've got you covered. The link is right below this video. It's completely free, no pitch, no pressure, just 15 minutes of street level data from my experience, so you don't step on the same landmines that others are. My calendar does fill up fast, especially for these free strategy sessions, so grab a slot before the calendar is completely booked. Seriously, this could be the most valuable 15 minutes you spend on your home search. Beyond those 5 hyper-local Nashville-specific mistakes, These are 3 common homebuyer errors that, while generic, sting extra hard in our current Nashville market. First up, not getting pre-underwritten. You might think that a pre-qualification letter is enough, but it's not the same. Pre-underwriting means your finances have been thoroughly vetted and you're essentially a cash buyer just waiting on the property. In our market, where inventory is still relatively tight for desirable homes and sellers often carry 2 mortgages, one for their old home, one for their new, adding 8 extra contracted close days for a full underwriting process is a huge turnoff. Sellers hate that. They want certainty and speed, and pre-underwriting gives you a massive competitive edge, often making your offer stand out even if it's not the absolute highest. Don't just get pre-approved, get pre-underwritten. Second, skipping the inspection on 1940s pier and post homes. Nashville is full of charming historic homes, many built in the 1940s with pier and post foundations. These homes are beautiful, but they come with their own quirks. Buyers often focus on big ticket items like the roof or HVAC, or they get a termite letter and they think they're covered. But here's the thing, that termite letter doesn't cover the original cast iron drain lines that run under these old homes. After 80 plus years, those cast iron pipes just rust. They crumble like Tennessee fudge. It's a silent hidden killer, and replacing them can cost tens of thousands of dollars. Always, always, always get a full comprehensive inspection that includes a sewer scope for those older properties. It's non-negotiable. And finally, emotional overbids. The median home price in Nashville right now is around $467,000. It's not the wild, wild west it once was, but desirable properties still see competition. If you get caught up in the moment and push your offer to say $520 on a 5% down payment, you are underwater the minute you pocket the keys. What does that mean? It means you owe more than the house is worth from day one. In a cooling market, that's a dangerous place to be, especially if you need to sell unexpectedly in a few years. It limits your equity, makes refinancing harder, and just creates unnecessary financial stress. Stick to the neighborhood ceiling, not your absolute maximum approval amount. Your lender might approve you for more, but that doesn't mean it's a smart financial decision. So there you have it, the top 5 hyper-local Nashville homebuyer mistakes, plus 3 more general ones that hit extra hard in our market. Nashville's real estate scene isn't the crazy hot, anything goes frenzy it once was, but it's still full of these unique, expensive gotchas that can catch even the savviest buyer off guard. Memorize these 5 crucial points. Investigate floodplains before you fall in love. Leverage those fantastic local assistance programs. Verify zoning for short-term rentals, and negotiate with builders like your money depends on it, because it does. Do these things and you'll navigate this market like a pro. You'll let the city pay you through incentives and smart decisions instead of paying for its mistakes. Hey, if you found this video helpful, do me a favor, hit that subscribe button for next week's deep dive. Thanks for spending a little time with me here in Music City. I'm Jameson Blackwell. Until next time.